Hey everybody, this is Brent from Wolf on Wall Street Trade with a market update for the week ending August 14th, 2020. If you didn't see the weekend video last weekend, it's because it wasn't there, but often I do have a weekend update out. It was just in text form on the website and it was open to the public. So if you don't see a video, check out the website. I often have a free weekend update there. So this past week of trade, actually past 2 weeks, but more so the past week, is a little strange, a little different. Not so much about risk on, risk off, up and down in the market, but it's more of a rotation. And I think after going through all the charts and all these different asset classes, I think I have an idea of what's going on here. From the way stocks acted, from the way sectors acted, from the way most shorted stocks acted, from the way gold acted, bonds, all that. I think it is about inflation expectations adjusting higher. So the market's been looking at this pandemic as a deflationary event. But then you look at what the central banks have done and what governments have done, and the U.S. running a huge deficit. And I think the market is starting to readjust its inflation expectations. So let's start with the S&P 500. This is a daily chart. So very little change this week. It was up like 0.6%. This February high over here is in play. The market has been, the S&P has been trying to hit this. It's been like 0.2% away. Can't get it. Kind of goes above it a little bit for a couple hours or minutes and loses it. So technically speaking, it's just a psychological magnet and prices want to go there. Here's a 5-minute chart of the S&P 500 and the week started here on the 10th. This is that level right here, that February closing high. So just barely above it for a few minutes over here, falls back down, barely above it, a few minutes over here, falls back down. You're talking about like 0.2% away. So it's really kind of odd that it's struggling so much, or was essentially a couple points. I've been demonstrating for members how weak market breadth has been, and we can see that on a daily chart, the S&P 500. So it's really close to that February closing high over there. But if you pull up the equal weighted S&P index, that's this one right here, the SPY, you can see it hasn't even really gotten above that June high. So that's just telling us that market breadth on this advance has been deteriorating on the way up. Here's a daily chart of the Nasdaq 100. I've been talking about what I think might be a distribution zone from, the bottom of this area around 10,500 up to about 11,000, above 11,000. Started right over here with this key reversal day, and you see the Nasdaq is just not making any progress. Gets up to this zone around 11,000. You see sellers come in. So on the week, 0.2% higher. I mean, nothing. It's basically flat on the week. And on a 30-minute chart, this is the key reversal day where you can see prices just dumped after a big gap up. And this to me just looks like a distribution process. Distribution is a process, it's not an event. So prices come down, the sellers are here, kind of let prices come back up again, start selling again around this 11,000 area. Prices come down, do it over and over and over because they have huge positions. So that's what I suspect is happening here in the Nasdaq. And breadth here has been very weak too. I've been pointing this out for a while now. This is the Nasdaq 100 in the candlesticks. And this white line is the percentage of Nasdaq 100 stocks, component stocks, that are above their 50-day moving average. You can see as we came into the beginning of the year, again, it was only 4 or 5 stocks driving the whole market higher because of their weight, but most stocks were starting to not make higher highs. So we see that process going on again over here. Here's that key reversal day. So this is that zone where I think we're seeing distribution. And what this line is telling us right here is that fewer and fewer stocks have been participating in this rally. Now, the last couple of weeks, it's been the Dow and small caps that have outperformed. So the Dow and the small caps are both well below their February highs. S&P is right there. Nasdaq is way above it. So from a certain perspective, these are kind of almost like value. But what I want to point out is when the Dow came down to these technical levels at the yellow 50-day and the blue 200-day moving average, we have 2 hammers there. It's bounced off that the last 2 weeks. The Dow was the best performing this week. It was really the only one that moved up 1.8%. And I think the last video I had, or maybe the one before that, I was pointing out, since that June reversal that we had, and this is going to be an important area to keep in mind over here as we go through this video. But since then, through this earnings season, just kind of been going sideways in this big consolidation. This is the last 2 weeks. So the Dow and small caps have been outperforming. As far as the bigger picture, notice where the Dow has kind of taken a break here and just kind of pulled back a little bit along this trend line. Let me show you what this trend line is. I'm going to back out. That's the huge broadening top that's been in effect since basically the start of 2018. So that's right where the Dow is right now, feeling a little bit of resistance there. And here's small caps IWM on a daily chart. Again, the last 2 weeks, you can see they had been holding right here at this 200-day moving average. The last 2 weeks have gotten a boost. And of course, like the Dow, well below the highs over here in February. In fact, actually, small caps are the only of the major averages that are in a primary downtrend, and they've been in that downtrend since 2018 top right there. So you have lower highs, okay, and even over here you have a lower high, and then you have lower lows over here. So this actually is in a primary downtrend. But as to the more recent action, and small caps are up 0.6% this week, same as the S&P. Like the Dow, since we had this reversal, this was kind of a reflationary bias in the market over here. And since then, we've been through earnings season going sideways. So the last 2 weeks, like the Dow, has been trading higher above this range, has been in favor. And on a daily chart, trading again, like it was in June, just above this long-term trend line, which is the trend that defines the entire bull market from the 2009 low. So broke below that, back tested. We're just kind of trading right above that, and you can see the primary downtrend over here developing with lower highs and lower lows. So this week was actually kind of like two parts. The first half of the week, or the first couple days, small caps were outperforming big time, and Nasdaq was underperforming. So this is IWM in the candlesticks, and this is the Nasdaq 100 in the white line. And I'm just showing you that generally speaking, this is April over here, generally speaking, they trend together. The market stocks trend together. You might see relative performance differences, one stronger than the other, but generally trend together. That was really strange this week. As you can see on this 5-minute chart coming into the week over here, again, this is small cap. So in the beginning of the week, they're tearing higher, and Nasdaq is getting hit. So Nasdaq over the last several months has been leading the whole market. So we're seeing this rotation this week from small cap, or from Nasdaq, from the mega caps into small caps, and that kind of stopped right here about Tuesday. And then from then on, you saw small caps kind of come down a little bit and Nasdaq kind of bounce. The point is that this kind of Rorschach-looking chart is highly, highly unusual, and this is really what I'm talking about when I say the market had some really weird things happening this week that weren't so much about risk on, risk off, but were more about repositioning, and I think it's about inflation. Now, the repositioning had been from the momentum and growth style factors, which is basically the FANGs and some of the defensive sectors, the mega cap tech, and into value, which has been the beaten up stuff that hasn't acted well this year, like banks and energy. Now, that benefited small caps. A lot of it was a short squeeze, but small caps are not value. They are more richly valued than the S&P. And a big part of their outperformance early in the week was all about a massive short squeeze, because the most beaten up stocks that have not been acting well were the ones that rallied early in the week, the value style factors. So this chart probably looks a little confusing. What it is the Nasdaq 100 in the candlesticks, and then this white line is an index of the most shorted stocks. So you can see they were heading down, and then as we come into August, basically the last 2 weeks, get this massive short squeeze. So you can see it here, where Nasdaq is just kind of going sideways over here. You can see the most shorted stocks are soaring. Now, if I change Nasdaq to IWM, you'll see why small caps benefited from this short squeeze. And now the candlesticks are IWM. You can see moving a lot more like this most shorted index. So the point is, the breakout from that triangle over the last 2 weeks in small caps has largely been driven by this short squeeze. And that is part of this rotation that I've been talking about, away from momentum and growth, which is basically like your mega cap stocks, the FANGs, and into value, which would be like energy and banks and industrials. And on that note, we'll look at S&P sectors this week. The best performing sectors were all these value cyclical sectors that are growth sensitive. So this is energy. It was one of the best performing on the week, up 2.7%. So the S&P was only up 0.6%. But as you can see, not technically significant in that it's still fighting resistance here at this 50-day moving average, well below levels where it was in February, and it was already acting horrible back then. The Kbw Bank Index was another outperformer, up about 2% on the week. And again, kind of like small caps, you can see it's been underperforming, hanging around this 50-day moving average, as it has been since really earnings season started. And by the way, Friday after the close, it came out Warren Buffett had sold all of his exposure to Goldman Sachs, a bank, and had been buying gold miner stock. And if you know Warren Buffett, he's never liked gold. He's always preferred to be in stock. And the industrial sector outperformed, up 3.2%. That's why the Dow outperformed everything else. Here's the 200-day moving average. You can see the last week and a half or so breaking out here. This is the rotation that I'm talking about. It's not so much about market risk on, risk off, as it is moving around money. The worst performing sectors were all defensive, so utilities down 1.8%. But as you can see, again, nothing technically significant in that. Still pinched between the 50-day moving average and the 200-day moving average. And the other one was another rate-sensitive defensive sector. Real estate down 1.75% on the week. Again, same thing, pinched between these moving averages. So it's not technically significant that it was the worst performing, but they are bond proxy sectors. Bonds got beaten up real bad this week. That means gold got beaten up real bad. And while not an underperformer, definitely a laggard. Technology sector, this is a weekly chart, so it was up 0.1%, 10 basis points on the week. So basically unchanged. You can see that in this weekly candle. Doji Star. And the other one that has a lot of mega cap exposure, for instance, Facebook. This is the communications sector. So down 0.2%, basically unchanged, but you can see just no movement here this past week. VIX was very, very little change on the week, only down 0.7%. And you can see it's hanging around, as one of my members pointed out, at this gap over here around 22. And there's the bottom of the gap down there. But we have seen relative strength in several of these volatility indexes, and more so in VVIX recently. Here's an intraday or 2-minute chart of the S&P 500 in the candlesticks, and you can see the dates down here. So here's the beginning of August, and this is VVIX. So it should be trading more like VIX, basically the opposite of the S&P. So you see the S&P go down, it goes up. You see the S&P up, it goes down. But if you look at the last week or so, S&P has been going up slightly. Look at VVIX, it's been tearing higher. So this is a pretty unusual signal that we're getting from VVIX. So while the S&P was very, very little changed on the week, you can see it over here, the big mover really was bonds this week. Here is the 10-year yield, it's a 2-hour chart. This is this week over here, so up like 14 basis points. So the last time we saw that kind of action was coming out of mid-May into early June with this reflationary signal. This is the last time we saw rotation to the value sectors, kind of pointing to that reflationary or inflationary outlook that the market is starting to get worried about. Technically speaking, on the daily chart here, it's kind of a reversion back to this 50-day moving average. So it's not a huge change technically speaking. And here you can see in June kind of did the same thing and then flopped real fast. So like I always say, a day doesn't make a trend, a week doesn't make a trend, but this is what the market is thinking about right now. The 30-year just got demolished. It was up 21 basis points. So we saw bear steepening in the yield curve, higher yields, steeper yield curves. That helps out the banks. And it just so happens that the banks were one of the outperformers this week, seeing rotation to them. So this is the regional banks over here. You can see they had been flat. This is the 5-year minus the 30-year yield curve or spread, which had been flattening, okay? And we've been watching this for a potential trade. This is this week, major steepening over here. Again, last time it happened was going into early June, and then it reversed real quick. The takeaway here is that this is reflationary or inflationary kind of behavior. So a big change in the market this week that we can really see in bond yields and how they acted. Reflation doesn't necessarily mean stocks higher. It doesn't necessarily mean risk on. Instead, what it seems to have been leading to this past week is a rotation out of areas like momentum. These have been the favorite trades, the mega caps, and we'll get to that in a minute as to why, and then into the value sectors that have been beaten down, that haven't acted very well. So I'll just breeze over commodities real quick, give you the stats on the week. USO for crude was up 1.6%, so not a big change, but it was up. Copper up 1.8%, or CPER, the ETF for that. Gold down 4.3%, silver down 6.15%. The precious metals got hammered. Gbtc for Bitcoin up 2.6%, not a lot of change there. So here's GLD for gold on a daily chart. This was the first time in 10 weeks that gold has been down. You can see the trend is still up. It still looks great, but this was a major shock to gold. And I've been saying I think gold is just way too extended. Silver too. Silver got hammered too. But I've been saying I think it's way too extended. This is one of my posts to my members, the daily wrap. This is from August 5th, and I was just talking about gold. I said I'm not negative on gold at all. I just think it's too extended from support with higher volatility than I'd like. So I don't want to chase prices entering a new position and have gold drop 3 or 4% suddenly. That's what it just did this past week. So this was written on August 5th, talking about, you can see the chart at that time, gold was just soaring. I was saying I don't want to be chasing these prices. Here's GLD on a 60-minute chart. So from a technical perspective, you can see here's the breakout from a really big base, very solid and very strong bullish consolidations. Then this is about where I expected we see a consolidation around 177. You can see prices just blew right through it. This is what I was saying. It's just too extended. And this is what we saw this week. I mean, just slammed. Why was gold slammed? Because gold has been following real rates. Actually, it's had an inverse relationship, but real rates have gone negative. Like a week or so ago, they were like negative 1.10%. So that was what was driving gold higher. So when we saw bond sell off this week and rates go higher, real rates jumped, gold fell. So this is why I'm saying I'm getting the kind of feel from all these different multiple asset classes and how they've acted, that what the market has been worrying about recently is inflation. So let's take a little closer look here. That's 15-minute chart. Here's that 177 level where I thought gold should spend some time and consolidate before our next leg higher. So this is kind of where I've been thinking maybe prices come down to. You can see after the drop over here, I think that was Tuesday morning, down like 4% or something. After that drop, you can see this consolidation here. It's got a little bit of a bearish kind of consolidation to it. So I wouldn't be surprised if gold came down a little bit more. And if you look at the extent of the move in bonds, the extent of the move in TLT compared to gold, it would also suggest that gold probably has a little bit more downside. I had bought some calls in GDX gold miners. So they were consolidating bullishly. They had a better chance of doing some catch up to gold. But when gold gets slammed like that, the gold miners are going to come down. As I mentioned earlier, came out on Friday that Warren Buffett sold all of his exposure to the banks, or at least to Goldman Sachs, and bought a gold miner. That gold miner was Barrick Gold. And if you look at GDX here, look at the price action. I'm going to pull up Barrick. There's Barrick. So this is what Warren Buffett has been buying recently. Very, very similar to the price action in GDX. And this is the gold copper ratio in red. And this is the 10-year yield. So when I brought it up, and I mentioned it in a video too, I said, you know, you could maybe look at a pairs trade, long gold, short copper, and look for this to revert down, for this ratio to revert down to yield. So if we walk this forward, that's pretty much exactly what has happened the last several weeks. You can see gold had been outperforming copper and moving down to yields. And then this week, of course, yields popped up. Gold came down, copper moved up a little bit. So that's why this ratio is up. But basically reverted back down to the reality of what the bond market was saying. Here's Gbtc, Grayscale Bitcoin Trust. I've been long this. This is a weekly chart. So here's where it broke out a little bit, and it's just kind of consolidating over here. I have no problems with this. I'm still long. Here it is on a 2-hour chart. This is the flag pole, and this is the bull flag. So we got long over in somewhere in here, around 10 or so, looking for this breakout. So this is basically about halfway up to the measured move for this first leg coming out of this bull flag. So it's not unusual to see a consolidation about halfway up from the breakout to the first near-term target around 1850. If we take a look at Bitcoin, this is a weekly chart, so you can see the Bitcoin prices over here. This is the 12,000 level, so there is some resistance there. You can see this line. That's where prices are right now. So Bitcoin is basically sitting there consolidating under that level, building up energy. Here's a closer look on a daily chart. There's 12,000. Here's price action. It looks like a little bullish ascending triangle over here. You've got resistance right there at 12,000. Buyers are more aggressive each time it dips, which is why you have this bullish ascending triangle after this bullish move up. So I have no problem with Gbtc, long it. I have no problem with Bitcoin. It's just got a resistance level there that it has to work through. Last week's post was mostly about the dollar. The dollar has been getting killed. That's been helping stocks. And on this weekly chart, actually a monthly chart of the US dollar index, what I pointed out a couple weeks ago was that the dollar had come to this major trend line from 2011. It spent the last couple of weeks right there. And what I've been saying is that this is an important, technical level, trend level, and we could see a bounce or even a short squeeze. And if we did in the dollar, it would shake up all kinds of assets from bonds to stocks to gold, everything. Here's a closer look at that level on a daily chart. So you can see the last couple of weeks it's been holding right there. And if we take a little closer look, we'll use a UUP 15-minute chart. This is the last couple of weeks in that area at that trend line. And what it may be turning into is an inverse head and shoulders. So this would basically be your neckline. It's not drawn perfectly. Left shoulder, head, and potentially forming a right shoulder here. If it was, and you got a breakout up here again, it would be really a big event, shaking up all kinds of different assets. Stocks have had pretty much an inverse correlation with the dollar. So as the dollar has gone down, they've gone up. So I would think that if we got, even if it's not a trend change, just a short squeeze, I would think it would have a lot of effect on a lot of different assets and catch a lot of people off guard. And for members, real quick, I closed out this plug long. You can see why I liked it. We had big bull flag over here, bullish consolidation here, another big bull flag over here, and got involved right over here. Take a little closer look. So this is that bull flag. This is the breakout from that bull flag starting, and it pulled back right here. So this small little bullish consolidation was like a fuse being lit, and this is why I bought it right in here, because we already had a breakout from this big bull flag, and it did really great. I mean, the options over here were up 350%, but when it dipped down later this week, this price action to me looked like there was a good chance that it could see a second leg down, and if that had happened, it would just wiped out the whole trade. I actually took enough of the position off right over here towards the close to pay for the complete trade, so I had nothing but profit at that point. But still, I didn't want to risk losing that extra gain over here, so I exited that. We'll take a look at it over the next few days, see how it goes, and really how the broader market looks too. But still, it was a double for a couple of weeks, and it's got, you know, a really strong price pattern. These are the things I like, so I don't mind going long the market, but I've got to have a reason. I've got to have an edge, and this price action was the edge. The original measured move target is about 1550, so again, maybe a consolidation here at the halfway point. So to just summarize, I'll pull up this chart again of IWM, small caps, and Nasdaq on the week. Again, so my feeling was it wasn't about risk on, risk off, because you can see one going up early in the week, one coming down, and then that kind of fading towards the end of the week. That whole rotation that happened from momentum to value right over here unwound by the end of the week. Then you've got the S&P that's kind of more or less in the middle of this, kind of going sideways and having trouble with that February high. I think the market is concerned about inflation. Here's TLT just hammered on the week as bonds got sold off, sent yields sharply higher, sent gold sharply lower. I did start a new short position on Friday, not so much because of this inflationary kind of stuff that's going on, but because of what was going on in credit, and specifically in high yield credit. HYG is very, very, very liquid, and a lot of professional traders will use that as a proxy for S&P futures. So here's the S&P 500 as we're going through the week. It's struggling up here with that February high, and this is HYG. A couple weeks ago, remember I said credit is supportive. When I think when the Dow was touching its 50 and 200-day moving average, you could see credit was leading higher. This is HYG this week, just getting pounded. And remember that this is an asset class that's backstopped by the Fed. Federal Reserve is buying high yield credit. They're actually buying the ETF as well. And it still acted this bad, this ugly. So what I did mention to members was high yield credit does not like higher rates. So potentially the rise in yields could have been affecting it here too. But last time we saw the same kind of rotation and reflationary activity was in early June or mid-May to early June. So let me show you what that looked like. It was right here. So this was yields exploding higher, the rotation, small caps, all that outperforming. Here's high yield credit. It was not bothered at all until we got the payrolls report right here on the 5th. And then we saw it start to negatively diverge from the S&P. And then we got about an 8% drop with high yield credit leading lower. So my point is that rising yields over here didn't bother it at all. And it wasn't until after that payrolls report we saw it negatively diverge. Look at the divergence here compared to this past week over here. This is why I started the position. I didn't go crazy on it. And this is what SPY looked like on the 3C chart as we went through the week. So that's kind of the backstory with that trade or getting that trade started. It's kind of a weird week, not so much about risk on, risk off, market moving up, down, technical levels. It's been more about traders, professional traders, moving money around under the surface, and it seems to be about inflation expectations moving up, which will be a problem for a lot of these stocks that are richly valued. That's really been justified by low rates. So I'm going to leave it there. I hope you enjoyed the video. If you did, please give it a thumbs up, and don't forget to click the subscribe button. I think it's down here in the lower right-hand corner. Check out the website at Wolf on Wall Street Trade. The link is down in the video description. You can follow me at Twitter, and check in with the website every once in a while. You can check out the free posts, or you can look at subscribing and becoming a member. So with that, everybody have a fantastic weekend. Maybe one of these weekends I'll take 2 days off, but it will not be this weekend. Enjoy yours, everybody. Take care.